Are you a current or future physician assistant wanting to learn more about finances? Then join me on this journey to become a PA the FI way. Hi, my name is Kat, and I'm a practicing certified physician assistant who will be your host. It took me 5 years after I started practicing medicine as a PA to thoroughly dive into my personal finances after I discovered the concept of financial independence. I want to use what I have learned to help you avoid some of the financial mistakes that I have made while sharing some of the financial wins that I have had along the way. Join me as we discuss financial strategies to guide you to becoming a physician assistant on the way to financial independence. Well, thank you so much, Paul, for sharing the 7 financial wins that you have had over the years. Let's move on to the 7 mistakes that you've made over the years. And the first that you have listed is company stock.
Yeah, this was one that that I personally suffered a little bit from, but basically in a lot of corporate type environments, sometimes your incentive package will include stock in your compensation. And that might be stock rights or stock options or restricted stock shares. Could be that you're just offered the opportunity to buy employee stock purchase plan shares at a reduced cost, or even have stock as an option in your 401k plan. And this is something that, I learned the hard way. There's a reason in all those SEC filings that the directors and officers liquidate a lot of their shares when they vest. The rule is the same whether you're an executive at the senior officer level or, down in the organization, let's say a mid-level manager that receives stock. When you get that stock, you're paying taxes based on the price and value at the time you vest in the shares. And so as an example, let's say your stock at the time you receive it is $50 a share, like it's restricted shares. So the entire $50 is going to be compensation. So you will pay federal income taxes on that stock at $50 a share. Well, let's say your business has a tough year and the stock goes down to $25 a share, and you're still holding those shares. So you paid federal income taxes at $50. Your basis is $50. The stock dropped to $25. Now, if you say, I need money for a down payment on a house, I'm going to sell that company stock. You're going to sell that stock at $25 a share. And let's say, you get your $25 a share, but there's $25 more that you actually paid federal taxes on that you basically lost.
Yeah.
Okay. And so in that example, and that's not an extreme example, I felt more pain than 50% loss on a lot of my stock. And I learned the lesson. But one of our employees, had worked formerly at Enron. And we all know Enron's story, maybe not, but it was a pretty dramatic house of cards that collapsed. Sure. And Enron, I believe, had their company stock in their 401k plans too, in a lot of cases. And so people literally lost everything, not only, the share values, but also retirement plans that had investments in company stock. And this lady, she joined our company after Enron began to fall apart. I can remember crystal clear the CEO walking into a staff meeting and saying, the Enron, first of all, do any of you own Enron stock? You might want to go outside and sell it. And second, there's going to be some great people on the street. We need to get some of them.
There you go.
And so there were some tremendous employees and some great talent in that organization. But the lesson that she tried to impart on me was, you need to sell anything that vests right after it vests. Don't hold it. You're already counting on that company for a paycheck and your 401k plan and your medical benefits and everything else. You don't need more risk in the company you work for than you already have. And, I thought, that's crazy. I'm going to let it go up and make a ton of money because whatever's $50 today is going to be $100 in 5 years. And I'm going to hold up and get that upside. Well, what I learned was, there was some upside, but there was also some downside. And in some markets and some businesses, you can imagine knowing what you paid for oil and gas when you filled up your car 10 years ago versus what you paid in the last 3 or 4 or 5 years, you realize that you're getting a bargain at the pump, which means somebody's feeling some pain in the energy industry. And so, we'll get into more specifics on that on another point here below. But anyway, getting out of that company stock position is something that I should have done, and I did not. I did not learn from her experience as much as I should have.
Okay. Well, then the second financial mistake that you feel as though you've made was that you feel as though you were too conservative over the years. In what ways do you feel like you were too conservative?
Well, this is something that I guess hindsight's always 20/20, but you learn that maybe your investment decisions, and by that I mean when you're putting money away, as we talked about in a 401k for 20, 30, 40 years, and there's probably not a lot of reason to buy any of the bond funds. If you're consistently investing in equities, through up and down cycles, but long-term up cycles, that money is going to work for you much harder if you're in equities and not if you're in bonds. And so, when your cumulative return on investment is let's say 20% or 15% in stocks in the last several years, to have money in bonds that actually in some cases shrank because the interest rates went down and stayed down and continue to be very depressed. And as they actually start going up, your value in that bond fund goes down because it was buying bonds at low rates. And now interest rates start going up and they were only paying a lower rate. So it's even worse. But long story short, having more of a exposure to equities would have helped me, and less money on the sidelines. Waiting for the correction that gets into market timing is something we'll talk about also. But the other big area where I felt like I was too conservative is my career decisions. One in terms of the career I pursued, as well as in given jobs, making the decision to move on or to leave the company for a potential promotion elsewhere when things got a little bit stale, whether it was the company or my department or whatever, is being able to actually see those and make decisions and to move on probably would have helped. Now, I will also say on the plus side, because I did spend a long period of time in two companies, that within those companies, particularly the one earlier in my career where I spent 12 years, I really kind of, developed my professional skill set in that company where I hired in as an accountant, reporting to a manager, and later moved up through being the youngest director in the company, to moving into another field, to moving up to corporate and picking up responsibility for treasury and reporting, and then again having a company bought out and realize it was time to leave, and knowing when it's time to move on is something that's really important. And because you can begin to position yourself and start building the relationships, which you probably should keep evergreen in case, surprises happen and you need to move somewhere. But, I will say there's one more point I want to make here, and I don't think it's anywhere on the list, is when I was going to college in the early 80s, I was bound and determined not to change my major. And I was going to get out of college in 3.5 years, which I actually did. I took some classes at a junior college, which is an extremely economical way to save money, even for today's students. Where you take classes while you're in high school or in the summer, and then you don't have to take them at the higher cost institution as long as they accept those transfer credits properly in your degree field. So I was set to, and I refused to change my major because to me, I valued getting out on time or early more important than maybe pursuing a different major. And I took every single elective in computer programming classes, and I absolutely loved it. I thrived on that stuff. Roll your clock back into the mid 80s. And that was the time that Microsoft and Oracle and all these early stage, software companies were kind of really finding their feet and becoming the future. Well, I kick myself every day for not getting out of accounting and taking computer science classes because I loved it. But, as passionate as I am, I was sticking to my commitment to get out on time and get an accounting degree. And so, I look back, and later in my career, I was able to do a lot of work in the IT side as well. But, you can't help but look back and say, well, what if I would have done that? So my word there is, if you're passionate about something and it's really something that you think you'll enjoy, it's okay to make a change. And that's something that I can say personally. A couple of my children have made decisions to change their careers or change their companies to get more fulfillment and joy out of what they're doing every day. And I completely supported it. And I think I wished I would have had the same guts that they have today. So something to be said for that.
That's wonderful advice. Thank you for sharing. And then you touched a little bit on the third mistake that you feel like you've made, which is market timing. Do you mind sharing a bit more about that?
Yeah, market timing is, we've all heard about people, holding money on the sidelines, waiting for the quote correction to happen, and then putting their money in, And I had a particularly painful one of these occur a few years back. I made the decision to roll a 401k over from the company I'd formerly worked for many years earlier to an IRA. And in the process of doing this, I took the money out of one plan. I didn't physically take custody. I had it sent to another firm, so I didn't have any kind of tax penalty. Yeah. But it went to the new destination, and it was right at the time, I guess it was 2016, the Trump election was taking place. And I'm like, this is going to be chaos. The market's going to drop. It's going to be confused. I'm going to wait and see what happens when the dust clears. Well, I waited till the dust cleared a little bit, and I realized that I'd already missed maybe 15 or 20% of market appreciation. Sure. Well, I had that money sitting in cash, and I'm like, okay, you should have known better. Yep. But long story short, I got it invested, and it's somewhat all invested now. But the lesson I learned was, you and I can't guess when those market moves are going to happen. And as much as I say, the market goes up over time, and I've read books, and the mentality is different than maybe the facts suggest. But when you have a lump sum, you need to put it in right away.
Definitely.
The best thing to do is get it invested. And I should have taken my own medicine there. So I will say that I have had the wherewithal during the last, several market corrections to not sell. So at least I know better in terms of stick to your investment policy, but I learned the hard way on, being out of the market when the market moves. And, and then the other thing I've done, from a market timing point of view is, I would buy a lot of individual stocks, earlier in my investing, career. And I made the mistake of, especially early on, I'd buy a stock, and when it was up 10%, I would sell it. Well, if it's a stock that's worth owning, it's a good, solid investment, there's no reason to sell it if you don't need the money. And so just seeing that it's up 10, I guess that was back when, there was a movie, I think called Millionaire Boys Club or something, that came out way, way, way back. But my coworker and I used to call ourselves the Billionaire Boys guys. Anyway, long story short, whenever one of our doors was closed, we were making a telephone call to a stockbroker and buying something. This is the way it happened in the 80s. And so, when you're paying a $35 commission and a stock moves $2 or $3, and you're finally up, and you have a spreadsheet, and you subtract your $35 commission, and this is what the price is, and I'll make this much. You're trading stocks and you're not investing. And later in my career, I started to buy what I call blue chip stocks, and we'll talk more about those. But selling with a 10% gain is not really investing. And in a when a little market move happens, and then later you find out, I owned Apple stock and stuff like that, where you sell it and then it goes up hundreds of percent or thousands of percent. So good companies are rewarded, and they do well, and holding them over a longer period of time would have made more sense.
So speaking of some individual stocks that you've invested over the years, it sounds like that's your fourth mistake that you've made. Do you have other individual stocks that you feel like you've regretted over the years, or different words of advice for us millennials?
Yeah, I was guilty of thinking I knew a little bit more about a particular industry than the rest of Wall Street or Main Street. When you work in a company that's in a certain business sector, you tend to get a lot of information about other companies in that space, and strategically, where they are moving to, and you start to maybe buy more in that sector than you probably should. And I bought a lot of stocks in the same space, and I learned the hard way. I wasn't any better at knowing how those companies were doing than anybody else, and it cost me in two ways. It cost me in diversification, because I began to get too much in one sector, and then it also cost me in terms of those companies went down just like any other company went down when they had business problems. And so that was a lesson I learned as well in individual stocks. But the other thing I want to mention is I looked at all my holdings, and I realized I had 132 different investments. And in those 132 investments, I had a bunch of individual stocks. And I can tell you, there's no way I was keeping up with each of those companies to the degree I should have to know if I should be holding them or selling them. And so with all of that, and also found a lot of overlap in terms of a lot of funds that own the same companies, I started to concentrate and sell those individual stocks and take that risk off the table, and move that money toward index funds. But one in particular, a blue chip stock that I own, General Electric, and I've got a point here. I own a good bit of General Electric in my holdings. And if General Electric struggled a few years back significantly. And, it was a blue chip stock. As a matter of fact, it was, I think, the longest running stock in the Dow Jones average. They were in the average from 1896 to 2018. So this is a company that you thought was a rock solid investment until it wasn't. Sure. And just last year, ExxonMobil and Pfizer and Raytheon were all taken out of the Dow Jones average. And those three were replaced by Salesforce, Amgen, and Honeywell. So my point is, what's rock solid and blue chip today may not be blue tomorrow. And I learned that the hard way. And so I finally sold off the last of my General Electric to offset some stock gains last year. And I'm so happy that I don't have to pull up a portfolio and see General Electric on it anymore. But, that's a lesson I learned the hard way.
Great. Well, thanks for sharing that. And then the fifth financial mistake that you've made has to do with rollover company plans. What do you mean by that?
Yeah, this one's a little bit complicated, but on one of your recent episodes, you talked about mega backdoor Roth, and that opportunity for moving money into a Roth, which I think is a tremendous, potential move to make. But the IRS has a pro rata rule that considers any deducted contributions or investment earnings in your traditional IRAs when you make a conversion. And if I would have done more research on this, I probably would not have rolled that plan over, because it would have given me a better position in terms of these backdoor Roth conversions. Sure. And so that's something that I look back and I think now, in hindsight, I should have maybe moved a little slower, but don't get me wrong. You got to take action and move things if you want to move them, but know all you can about the facts around it. And doing a little homework, maybe even reaching out to a professional tax guy would have been a better idea on this one. And that's my point of putting it on the list. I don't know to what degree this is going to hurt me, but I can tell you it's something that is an option that may still be an option, but not as beneficial is my point.
Certainly. And then the sixth mistake that you would like to share is variable whole life policy. So unfortunately, lots of us have experienced this, myself included, but do you mind sharing your story about this?
Sure. If you can picture in your mind a young parent, my wife and I have two little kids running around, and a very well-trained personal friend of ours was an insurance sales guy, and he worked his magic on me, and while your wife is watching the kids in the next room, you don't want to leave your wife with no financial resources if something happens to you. And this is a great investment process. This whole life will have a cash value, and it's a tax benefit to you, and all of the sales jargon. And when you're young and don't have as much perspective, a strong, confident salesman is going to be really good at his job, and you got a target on your head. And I was a target. I bought the farm in terms of, I really didn't buy the farm, but I bought two policies from this very large, reputable life insurance company. On the positive side, at least it's a large, reputable company. On the negative side, I bought a term policy and I bought a variable whole policy. Well, the premium for that term policy was, let's call it $60, and the premium, and I think they're equal cash value or payout policy face amounts at the time, was like $240, $243, I think. And so it was a substantially higher cost when, back when my income was much lower. And now the conventional wisdom, which is very true, is you need life insurance for what it's for. Okay, I needed term policy, and I needed it to take care of my family if something happened to me as a primary wage earner. But did I need it as an investment solution? Did I need it as a beneficial tax financial instrument? No, absolutely not. And so, had I bought the same face value of term for the combined value and taken that extra and invested it in the stock market over the last 27 years or however many years I had that policy, I don't need to tell you the math on that, but it would be astronomically better, if I would have taken that, call it 180 or whatever the net is, and invested it in the market every month. But that was something that I succumbed to, all the sales tactics. And even though I'm a CPA, I'm a rational financial guy, I bought it, and it was not a smart decision. And so I think that if you just remember one thing, term life, that's all you need to remember. Buy a term package, a term policy, and you're much better off investing in an investment company, not in a life insurance company. So you mentioned that's something that affected you as well.
Yes, I completely agree. Unfortunately, right out of PA school, my husband and I started working with a quote unquote financial advisor. We fell prey to investing with our life insurance, which you probably should not be mixing life insurance and investing. And we probably lost a fair amount of money. And I should have seen this as a huge red flag, but right out of PA school, I was really wanting to pay off my student loans ASAP. And I was talking to him about a strategy of how to do this. And he goes, "Oh, you can just take your time. You should really be focusing on this instead with your money." And again, I was too naive and probably pretty trusting. He's this financial expert. So I took his advice and have been paying off student loans very slowly over the years instead of paying them off quickly and just being done with them already. So we were able to fire our financial advisor, and we haven't looked back since. And we do have term life insurance now that we are completely happy with. So thanks for sharing your story about it too.
Well, excellent. Don't beat yourself up, because you can't change the past, but you can certainly move forward in the future. And you know that you got the train back on the track and you're moving forward. So that's excellent.
Exactly. And then your seventh financial mistake that you like to share is new cars over the years.
Yeah, this is one of those ones that it seems kind of obvious, but maybe it's not, because it's death by 1,000 monthly payments, right? One of the biggest impacts, you can have, particularly earlier in your career is putting that money away earlier. And when you make the decision to buy a brand spanking new, smelling great car, if you're addicted to new car smell, you know what I mean, you'll make some large payments, or maybe even you lease it, and it's basically an expense for that lease period. And then hopefully they don't tag you with any mileage overruns or any, damage to the vehicle, or dings or dents or scratches or whatever. But, you can spend a ton of money on cars. And I actually wrote a pretty extensive post, 5.0, called "To Discover the Secret Turbocharger to Your Early Retirement" in my blog. And, basically this can be $1 million difference over a 30-year period with you and your partner, buying cars, and so it's one of those things where, we bought some new cars in our life, but we've also, there was a point where I kind of saw the light along the way, and I began to buy secondhand cars or used cars. And at the time, I had kids that were getting close to college age, and I began commuting a lot. And it was something where I bought a 2005, I guess was the last new car I bought. Now, granted, it was a Honda Civic, and I was commuting a long distance at the time to my job. And it was great timing, because I bought it right before the gas prices started going up after the hurricanes began to hit refineries and things, and take out capacity, forcing gas prices up. But, it worked out well for me. But I didn't buy another new car for many, many years. I bought, some Corolla, a Ford Focus. I had the Civic I was driving, and an older Ford Chevy truck. And those ended up being the cars that got me between that last new car and then in 2016, when my wife said, you haven't bought a car for yourself in 11 years. You need to go get a new truck. And so I ended up doing that. I bought one. It was a demo that had 7,000 miles on it. And I felt like I got a good deal on it. But, my point is, if you spend the money to buy the top dollar car and get a loan, and it depreciates, and you're making payments, and you're paying financial costs, and your insurance will be higher, and all those things that go along with it. If you conversely buy a more modest vehicle, let's say you buy the Honda Accord or the Toyota Camry or a Civic or a Corolla, if you wanted to work down that equation, you'll spend a whole lot less on the car. And if it's a 2 or 3 year old car that has 30, 40, 50,000 miles on it, and you drive it 150,000 miles, you pay cash for that car, it's a completely different equation over that 30-year period. And so you can save a tremendous amount of money by buying used cars and driving them longer, as long as it makes sense. Obviously, if you get a car that seems to have perpetual repair problems, you probably need to move on to a different vehicle. But conversely, one of the cars that we drove 185,000 miles, it was a Suburban. We sold it to another guy, and he used it in his catering business. He called us. He says, the Suburban finally died. It made it over 300,000 miles.
That's awesome.
So he paid cash for that Suburban when he bought it from us. As a matter of fact, they've actually bought another Suburban from us since then, that we had driven a good number of miles as well. So, our philosophy has kind of been, mom's got the reliable family vehicle, the drop off all the kids at ball practice and all those things over the years. And it was the one we traveled in if we took, travel at road trips. Right. So, we really used it. We enjoyed it, but we drove it a lot of miles.
Sure. That's great. That's so funny that you mentioned Suburbans, because before my husband and I learned about financial independence, we had leased a brand new Jeep Grand Cherokee, had all the features, heated leather seats, which was amazing up here in the upper Midwest. And it also had remote start. It could parallel park and 90-degree back itself, and we used those features 0 times while we were leasing it. But my dear husband wanted the Hemi, so he wanted that Grand Cherokee that was more expensive than the other one that I was like perfectly content with as I was moving up from a Hyundai Elantra after 9 years of driving that. So we finished our lease, and when we returned the lease for that Jeep Grand Cherokee, I felt just as happy as if I were buying a new car. I was like, I'm so done with this thing, so done with those payments. And we've instead bought a 2004 Suburban with $5,000 in cash from one of his great uncles who took meticulously accurate care and kept complete records of this thing. And it's not the nicest feature. It doesn't have those heated leather seats in the winter, the remote start. I have to go out there in those snowstorms. But every time I drive it, I am completely content because there are 192,000 miles on it. But it's great to know that maybe it can reach 300,000 miles. And I will be so content knowing that I'm just saving a ton of money where it's not going down the toilet every single month and instead being able to invest it. So thanks for sharing that.
Well, that is incredible that you actually made that change to take that action and pay cash for a vehicle that didn't smell new when you got it home. But I bet you can haul more stuff than anybody else. And, and I particularly the heated seats in the Midwest, that is a big one.
It is. It is.
Down here, there's those packages that have heated seats, and then there's the package that has cooled seats.
It had that too.
In the South, we like the cool stuff even more. But I will tell you, my wife's Suburban has that heated steering wheel and heated seats, and there's nothing she likes more in the wintertime than starting it up and letting it warm up and then grabbing that wheel and it's not freezing her hands off. But that's not much of a sacrifice because, as you said, there are so many options on some of these vehicles that you never use.
Exactly.
And you're actually paying for them. So
totally.
Yeah, that's excellent. Well, that'll make a huge difference in you're paying your loans off quicker and everything else, because that's not going to be a big payment every month.
For sure. Exactly. Well, thank you so much, Paul, for sharing your 7 financial mistakes that you've made over the years. Next, we have 7 words of advice that you have for millennials. And the first suggestion that you have is to read The Simple Path to Wealth by J.L. Collins. So tell us what you like about that book.
Well, this is a great book. And for me, it was actually a page turner. I obviously read it on in a different situation than maybe you would be reading it. But even as an early retiree, I read this book and I thought to myself, if only I could have had this philosophy completely, 25, 30 years ago, it would have completely changed my situation in terms of it being so much better even than it is. So there was some great words of wisdom in that book, but more so it was very straightforward. It was a very reasonable perspective with the terms that he tries to communicate in the book, actually does communicate in the book. And I felt like it would have made a big difference, in my approach. One of the things he talks a lot about is index funds and not necessarily buying individual stocks, but, the risk mitigation you get with an index fund and market performance and how many things don't perform better than the market, these managed mutual funds and such. And so at my point, I'm happy with market performance. I don't need to beat the market, nor do I believe most people can beat the market. And so I wish that I would not have done the things I did with individual stocks over the years that I did. But this book, I was on about page 100. And I literally put the book down, went over to my computer and opened a Vanguard account, which is a significant account now in my portfolio holdings I have today. But it's like I'd heard a lot about Vanguard, but I needed to know more. And so I opened up an account. I do a lot of automatic investing with them. And I think reading this book will give you the perspective. And I put it number 1 on the list because I think you need the whole perspective in investing and in these life decisions and financial impacts of those decisions kind of up front. And then once you build that basic knowledge, then you can move forward with the other execution of steps toward financial independence.
Sure. Yeah, I will include a link to that book in the show notes for today because I've read it as well. And I think it's excellent for giving advice of how to get started with investing and why it's important to invest in index funds and things like that. And then the second word of advice that you have for millennials is to know where your money goes.
Yeah, this if you really don't have a bearing of where you are, it's kind of hard to figure out how to get where you want to go. And this is so true with financial independence. If you don't know where you're spending your money and how much you're spending, then it's really hard to kind of ascertain how much of a gap you have between what you make and what you spend. Because as we all know, the gap is what gives you the growth and the fuel for your financial independence. So, I wrote a pretty extensive blog post 9.0 about conscious spending, but the crux of it is, knowing where your money goes, downloading your transactions from your debit, if you use a debit card, from your bank account, if you use like a credit card, from your credit card statement, download that stuff, get it in a category, do some analysis. It doesn't matter if you use a paper and a pencil or if you use a pivot table in Excel, which is one of my favorite tools to analyze a lot of data, but get a grasp on where you're spending your money to make sure that you're not hemorrhaging. In some cases, like let's say you have Netflix and Hulu and you name it. You start adding up all the different TV streaming services, and it may be that you have 5 or 6 or 7 of those. Do you really need them all? Do you are you even aware? Because it's like the 1,000 paper cuts, $10 a month. That's nothing. Do I even look at it? Well, when you add 10 services together, and it really comes up to $150 a month, you might want to be aware of it. So, but knowing where your expenses level are, where the expense is, and if it makes sense to continue to be paying it.
Sure. And then the third suggestion that you have for millennials is to build a cash cushion or emergency fund. And I know that we talked a little bit about this earlier, but do you have some other points that you'd like to mention about this?
Yeah, I think we covered this pretty extensively earlier, but it's just the peace of mind that it provides, and having that cash, like I said, gives you options, and the bumps on the road, the speed bumps, they're not going to knock you off the road when you have an emergency fund. If you've got to go buy $1,000 worth of tires for your vehicle, you've got that money, it's set aside. You spend it, you replace your emergency fund over the future months, and you basically become your own bank. And so you're not running up credit card debt, and those type of things. So emergency funds are really critical.
Great. And then the fourth recommendation that you have is to get debt free. And why is that?
It's really hard to begin investing if you're making a bunch of payments on debt. And as you mentioned, student loans, lease payments, car payments, all those things are fairly substantial numbers usually in your budget when you're younger in your career. And getting debt free, suddenly when you're not making those payments, all those dollars are going into investments. And so, one of the things about, having a very healthy financial life is you're able to pay your bills. Well, sometimes you have some debt, and by that I mean things like a mortgage potentially, or maybe even a car loan that you pay back quickly. Those type of things I can understand. They're big lumpy purchases, and it's harder to be able to pay cash for a home. But conversely, if you're making credit card payments and you're paying minimum payments or paying, a third of what the bill is, there might be a bigger problem than you realize. You might actually be spending more money than you're making, and you don't even realize it because, hey, I'm able to pay my bills. I pay all my bills. I pay on my credit cards. Well, there's a difference between paying on your card and paying off your card. It's painfully obvious, but it's probably a symptom that you're overspending if you continue to pay a minimum payment or a smaller payment than your full bill. And it's one thing if you have like a surprise thing that hits you let's say the example with new tires where you spend $1,000 on your credit card for your tires, and maybe you split that and pay it off on 2 months instead of 1 month. Okay, well, that's a really lumpy expense, and I can understand that. But if you go out and party with your friends and spend money at a bar or restaurant, and then you're paying for that over the next 18 months, let me just be real clear, that liquor has already passed through your body many, many months back.
Sure.
You're not getting a benefit out of it, but you're paying interest on it still, 18 months later. And I hate to use that example, but there's a concept in accounting, going back to my professional background, called the matching concept, where you want to try to match the revenue with the expense, or in this case, you may want to match the joy with the expense.
Sure.
So if you're going out and having a nice time, nice dinner with your friends, you need to pay for it when you do it,
Yeah.
and not for the next 18 months. And so that's one of those points as well.
Definitely. And then your fifth suggestion for millennials is to start investing today. Do you mean literally today, Paul?
I do. I mean, literally today, and this kind of assumes that you don't have any credit card debt when I say today, because, I didn't mention earlier, if you've got credit card debt, you're probably paying a 25% finance charge on that credit card. So let me just be real clear. I would make any investment today if it guaranteed me a 25%
Right.
return. And while you can't get guaranteed returns on any kind of financial investments, you can get a guaranteed return on paying your debt off, because you know what the interest rate is. You owe the money. The sooner you pay it off, the sooner you save that 25%. So get out of debt, get out of that higher credit card debt. But by all means, start investing today. I talked to my daughter this morning, and she says, "Hey, I invested yesterday." And she was kind of joking because, she's got an account set up that automatically invests every week. And so she was a little, let's just say, she was, quote, too busy to ever set all that stuff
Sure.
up. So she and I set some stuff up the other day. I said, you have got to start putting money in. You can't say that you're going to wait for the market to drop, and if you just make it automatic, you don't have to think about it. You just know it's happening every week, every Wednesday or every Thursday or whatever day of the week you want to pick. You can set these things up. And so I'm a huge fan of automation. I've got some automated transactions that happen between funding my HSA account and covering our expenses every month. Fidelity, Vanguard, M1, even Acorns, or some of the robo investing systems. Any of them make sense in terms of being able to automate, and by doing that, it's something that's passively taking place. So, at the end of the year, you put in a little money every week, and in the scenario, if you take the Rip Van Winkle approach and you wake up in several years, you'll realize that suddenly you got $10,000 or $100,000 or $1 million, depending on how much you invest. But when you do it automatically, it happens. It happens. It will happen. And the hardest thing is to have that discipline and mentality of, getting started, taking action. And if you don't ever invest, it won't grow. And I talked to somebody last week that had inherited at a reunion, and they had inherited a large sum of money from a parent, and it had been sitting in cash for 5 years.
Wow.
And I just hurt inside when she tells me this story, because of that opportunity cost. It had you, even if you felt like the market was too high, if you put it in over time, you're still going to get it in the market and put it to work. And so, the emotions are something that you struggle with when you read the facts that say invest today, no matter what, the lump sum. Yeah, it's still hard to do it all at once. But you know what? If you spread it out over a year or 3 years, and you just do, every quarter you're putting in a chunk, at least it'll eventually get in the market. If it's in there for a long time, it'll still help.
Definitely. And then we did touch on point number 6 for your advice for millennials about buying a reliable, gently used, already depreciated vehicle. Do you have any more suggestions or points that you'd like to touch on about that?
Yeah, I think we covered this one pretty thoroughly. But remember, you're going to be buying vehicles probably most of your lifetime. And once you kind of adopt the philosophy that you explained what you did personally, which is if you get to the point of realizing it's an A to B
Mm-hmm.
item, it gets me from A to B. It's transportation. It's reliable. It takes care of what I need it to do. And it's not a
For
trophy.
sure.
It's not a symbol of wealth to have. I drove a Toyota Corolla. That was the last car I drove. And until I bought that truck. I did buy the truck before I retired, but I took a lot of crap from people over my Honda Civic and the Toyota Corolla and the Ford Focus, which actually in the three, the Ford was the least desirable in terms of my experience, but I really had a great experience. And the other two cars are still on the road today. My kids are all driving these old vehicles, and the 2005 Honda still going, and my son drove it for 4 years in college and 5 years in MD PhD school, and still going strong. And the 2004 Chevy still a daily driver for my other son, and my daughter's driving the Corolla. They have this addiction to paid for cars, I guess. I don't know where they get these things.
Well, it's good that you're able to instill those words of wisdom with your kiddos over the years.
I try.
Awesome. And then the seventh and final advice that you have for millennials is to grow the gap. What do you mean by that?
Grow the gap. We took a vacation over to the UK a few years back, and they have this announcement on the subway. It says, mind the gap. And they're talking about the gap between the platform and the train. But, that stuck in my mind. And my mantra has been grow the gap on my podcast. The difference between income and expenses is the gap. And if you grow the gap, you're going to have resources for financial independence. And, there's two key points here. It doesn't matter which lines you grow, that'll impact the result, but growing the income line, and not growing expenses, you will get a larger gap. So as you get a raise or a promotion, if you don't increase your lifestyle to spend that money, you will be growing the gap and living below your means, and making decisions along the way when your compensation starts to creep up, not letting your expenses move up as much, will increase your ability to put money away in investments or rental properties or whatever your means of growing that wealth are. And so by growing the gap, that's what I mean. Increase your income or decrease your expenses, or even just holding your expenses flat.
Sure.
As we all know, inflation causes things to go up. And so if you can hold your expenses flat during a period of inflation, you're actually reducing them.
Yeah, that's great. Well, thank you so much, Paul, for sharing your triple sevens, which were your 7 financial wins, 7 financial mistakes, and your 7 words of advice for millennials. Since you are the first guest that I have on that has actually reached financial independence, I do have just a few more questions to ask just to kind of get a little bit more background about that. So once you actually reached financial independence, how did you actually access your money in early retirement? Because so many of us hear about how for many retirement accounts, you have to wait until at least 59 and a half to access your money, which we know in the FI community that it's a little bit of a myth. You can actually access your money a little bit earlier. But you mentioned you retired in your mid-50s. So do you have any tips or tricks for us that might retire before the age 59 and a half?
Yeah, I was able to put away money in after-tax investments primarily, and I do have a bit of a bucket philosophy approach in how we handle our finances. But by that, I mean you kind of set aside buckets for certain purposes. And so for me on the near term, until we reach the age of 59 and a half and have those other options of being able to take, traditionally take money out of those retirement plans, we had money set aside in after-tax investments that is invested in a conservative way. By that, I mean it's not all in equities, that meets our financial needs for expenses every month. And my wife, as I said earlier, is still working part-time. So her part-time salary also helps tremendously in meeting expenses. And so we're able to use those after-tax accounts to meet most of our needs and not have to worry about any kind of early withdrawal schemes. As you mentioned, there are ways to get money earlier, but they're a little bit more complicated,
Sure.
and it's nice to not have to do any of that. So that's kind of the way we handle it.
So essentially, you would suggest if someone is able to save more than a 401k, HSA, Roth IRA per year to try to invest the extra money into a taxable brokerage account, so then they have those funds there that they can use to help bridge them until they're able to get their retirement accounts money out. Is that correct?
Absolutely, yes, and that's I think one of the easiest options, and by having it in an after tax account, you can also use it for any number of things. It gives you the ultimate flexibility, like I mentioned. If you choose to invest in more rental properties or something, that money is all easily accessible to make any other types of transactions. So having a chunk, and I didn't mention it earlier, but I have this concept of being half right or half wrong. If you don't know any one best solution, it's okay to do a little of this and a little of that, because then you will have the options that each of those decisions give you. So that's kind of what we've done.
That's great. And then my next question for you as an early retiree is, did you experience something called one more year syndrome, which is where many early retirees have reached financial independence, but they end up working for at least one more year past the point of FI? And if you did experience that, what do you view as some pros and cons of working past the point of financial independence?
Wow, that's a great question, and absolutely, you think this is a crazy concept until you're at that point in your life where you're making more money than you've ever made before, and you know how much extra security. And you mentioned, is there a benefit to working one more year? And I would say yes, there's a benefit, and that benefit is putting one more year's worth of savings away. Because at that point in my career, we were saving close to 80% of our pay, and I mean, that's probably something that's hard to do, maybe even in your point in your career right now, for you to say you're saving 80%. I'd say, how are you doing it?
Sure.
unless you're making $500,000 a year already and you only need a little bit to live off of. But for us, we were, when you're debt free and you're well compensated, there's no reason not to be saving a lot of money. And so you see how quickly your financial assets start piling up. It's really, really hard to say, I've got enough, I can walk away. And, and, and even though the spreadsheets and everything else that we had done, uh, you know, I, I think for me, the one more year syndrome, because of my professional career as a CPA and auditor and working in compliance areas and other, part of my job was to figure out what could go wrong. Okay. So that mentality on a spreadsheet for your financial future, and I call this my life plan spreadsheet. I talk about this in the podcast, but basically, annual expenses going out until you die. That's a hard, gross thing to say, but you decide how long I'm going to live and, what are my expenses going to look like. And so you build into this the knowns, and then your financial training says, but there are unknowns and you need contingencies to cover those unknowns. And so you start putting in I might have to do this, I might have this surprise, I might have a medical, all these unknowns. And the problem I had was not seeing the other side of the coin. And I finally started, checking myself and saying, things can go right too. They don't all just go wrong. And number one, all those contingencies are not going to happen at the same time or maybe ever. But, I had built them into the plan, and I'm like, you know what? I don't need to plan for all these things to happen. Now, do I have a contingency in my financial plan? Absolutely. Because there are things that will happen. And if they don't happen, that's money that's available for lifestyle,
Sure.
right? Or for legacy, or for charitable giving, or because all those things are important. Donor advised funds, something we have. There's a lot of things, in life that you may want to do, and one of those is help other people. So you put that stuff in your plan, or other organizations that you have passion to support. And so anyway, you build the plan, but realize that not all the negatives are going to happen, but you do need to plan for some contingencies. So, that's one of the things that fed against, the one more year thing. Well, if I make a little more money, I can cover more contingencies. Well, you don't even know what those are going to be.
Sure.
And so, for me, that was part of the challenge. And the other thing is, the market. There's a thing called sequence of return risk, and that was very near and dear to my mentality because, if you retire and then the market has a really bad string of years and you're taking money out of assets that is depreciated, it can't recover, depending on, the size of your portfolio and stuff. So literally right after I make the decision to retire, the market kind of had a little hiccup. And this was at the end of
Sure.
2019. Well, then it had a really big hiccup in 2020,
Yeah.
right? And so I saw our portfolio shrink, and it only shrank, I don't know, 25% maybe. It wasn't as much as the whole
Yep.
market because I wasn't all in
Sure.
equities, right? But it was still a huge number on paper, and it scared me. And fortunately, all the things that I had in place, like the bucket I mentioned that was not in equities, that covered our expenses, and the fact that I stuck to our investment policy, which is leave it in
Yep.
and let it recover. As J.L. Collins says, the market will continue its relentless pursuit up and to the right. Okay. Well, if you believe it and you live it, leave your money alone and it will recover. And it did just that, and then a whole lot more. So, my financial models were more conservative because I tend to be more conservative when I'm, projecting something that my life depends on those assets lasting longer than me. So I believe in being conservative in your model, and I believe in having some contingencies provided in your model, when you're making those decisions.
That's great advice. Thank you. And then my final question that I have for you as an early retiree is, did you retire towards something? In that, do you feel like you have lots of plans for retirement? Have you been pursuing different projects, hobbies, adventures? And if so, can you please share what some of those have been?
Yeah, I'd be glad to. I would say first off, yes, I can sort of say I retired towards something, but I had a list, and as you might imagine, I'm kind of an analytical black and white person in terms of decision making, and you pull out the sheet, or you have a spreadsheet. On the left side you got pros, and on the right side you got your cons. And so I listed out all the things that I would enjoy doing as a retiree, and then I listed out all the things that were negatives about retiring, early, and making this decision to leave. And there were a lot of things on that list on both sides, and some are heavier weighted. You could get into weighting and analysis and quantifying everything, but a lot of it is more subjective, and there are things that I believe that I've actually fulfilled, and I'm pursuing those items, just as I thought I would. And there are things on the list that I'm not pursuing as much as I thought I would. And, but one of the things on the list is, my wife and I used to have an RV when the kids were young, and we really enjoyed it. And she did a lot of camping growing up, and it's something we enjoyed. So that's something that we plan to do a lot more travel. And I say slow travel, I guess, more so than just travel. We spent 2 weeks recently on this anniversary trip to several national parks, and covered 3,800 miles in her Suburban. Okay, so we managed to do that and stay married, but I don't think we've ever taken 2 weeks off. Certainly never taken 2 weeks off with no kids. Okay, so taking 2 weeks off, I told my wife, I said, this is like a sampler trip. This is going to be kind of what it's like. And we got and we Airbnb'd it all the way, up and back, and had some great hikes, really enjoyed, Rocky Mountain National Park and the Grand Tetons, and even one day in Yellowstone to see bison swimming the Yellowstone River, and then jumping across a creek and their migration, they're starting. It was the only thing we didn't see was a bear on the trip. We saw moose and we saw elk and deer and all those things. But we had our bear spray ready, but we never got to see a bear.
That's probably good.
But travel is something that I think we really plan to do more of, and we had a great 2-week trip, and spent, like I said, 38 miles together. We're still married, we're still happy, and I can see us spending a lot more time traveling when she fully retires. The other thing I've done is I've enjoyed gardening. My middle child is an avid gardener, and he has got me involved in doing a lot of projects and teaching me things. And he is a big fan of growing things from seeds. And so I've begun to do some of that. You're making a transition when your birthday card comes, and inside the birthday card are 3 seed packets that he's harvested from his plants for me to start growing them.
That sounds so fun.
As one of the more unique birthday presents that I got was his own seed stock. So it was pretty crazy, but I've enjoyed growing things. And I want to hit on this because it's something I didn't know. It's a surprise in retirement is, we've got some, it's not a large place, but we got a little over an acre here around the house. And when you retire and you're physically taking walks in the yard, this is crazy, but you notice when certain wildflowers appear. And you notice that there's an early spring set of flowers and a late spring set of flowers, and there's some flowers that hang on through the summer. And in the South, where it's really hot, it's pretty brown out there right now. We're kind of recovering from the hottest month of the year, and it is just to see the seasons change and what all is happening at a more finite level. It's like, this stuff has been happening every year, but I've never experienced it, because I don't ever have time. and you start to really appreciate the walk around the backyard with a cup of coffee and the dogs at a different level. And I know it sounds kind of goofy talking like that, but I've become quite a birder, and I love, as I sit here today, I've in my study, I've got my binoculars handy, and anytime I see a bird outside, it's something that I enjoy watching, and I tend to take them when I travel. And there are a lot of things you can do with a pair of binoculars, watch airplanes, look at birds, watch sporting events. As a pro tip, get a nice pair of binoculars. You will use them your entire life, so, but anyway, the other things, I spend a lot of time in some volunteer roles, and I've used my skills for that and really enjoy it. Those are fulfilling things. Different committees and fundraising efforts and financial models and financing options, and, just raising capital for projects. Those are the type of things. And then the one thing that I really enjoy that I've done a little bit of is I've helped people, some millennials that have started businesses, and help them work through some of the financial aspects and the monetary challenges that they have. Like, if you were to start your own PA business practice, there are a lot of things that you may be unfamiliar with, and to have, advice, and free advice that hopefully is competent from someone with some experience, is something that can really get you pointed in the right directions. And so I've really enjoyed spending some time with some younger folks that are just kind of getting their feet going on their own practices and helping them through those decision points. So those are some of the things that I do. I will say there's some things that, some stretch goals that I still need to work on, but retiring in the COVID year really kind of made it a funky fog for that first year. And so I'm right at 2 years, and I'm still having some challenges to kind of find my way on some of the things I want to do. if that answers your question. I think it may
Yeah,
sort of.
definitely.
But blogging and podcasting, I left that out, but blogging and podcasting is something that I've really enjoyed, and it was one of my goals. So at least I can say that one's going well.
Yeah, that's amazing. Thank you so much for sharing all of the things that you've started to be able to do in your retirement and what you hope to do in the future. I think that's great. And where can the listeners find you, Paul, if they would like to follow along with your podcast or take a look at your blog?
Sure. They can find my webpage at FIlightER.com. That's www.FIlightER.com. FIlightER, just like highlighter, only it's FIlightER. So right there on that webpage, you'll see a link to my podcast and my blog. And I welcome your comments and feedback. So please feel free to leave those.
That's great. I will make sure to include links to those in the show notes today as well. So thank you. And thanks so much, Paul, for taking the time to share your absolute wealth of information that you have shared over today's episode. I'm sure that all the advice that you have shared for us as millennials or other listeners today will be incredibly motivating to the listeners who are pursuing financial independence. So thank you so much.
Well, thank you, and the one point I'll leave you with is take action on one of these things. Just take action. The hardest thing is to move from where you are to a place that may be a little less comfortable, but it will tremendously help your pursuit of FI in the long run. So thank you for having me today. It's really been a joy talking with you, and keep on going the PA the FI way. We'll stay tuned to your future broadcasts.
Awesome.
As well.
Thanks, Paul. And to the listeners, check out the FIlightER podcast. And if you enjoyed today's episode, share with another millennial that you know. Write a review of what you enjoyed about the show, and subscribe for future content. Thanks again. Thank you for tuning in, and I hope that you decide to continue to join me along this journey of becoming a PA the FI way. Please take a moment to press the subscribe button on the platform that you are listening to this on. But more importantly, consider sharing with another current or future PA that could benefit from the information that we reviewed in this episode. Take care and have a great rest of your day. Until next time.